Collateral. The practice of securing loans with assets is a cornerstone of credit extension and risk management. Though it may not frequently garner attention, collateral plays a vital role in maintaining the stability of financial systems.
This is the story of a financial disaster that we hoped would never happen again.
The 2008 financial crisis was far beyond the confines of Wall Street.
In this video, we investigate the history of collateral, its influence on the financial landscape, and recent policy shifts with potentially significant implications. On March 19th, America's Federal Reserve announced it would reactivate daily dollar swap lines with Britain, Canada, the Euro area, Japan, and Switzerland. It allows several central banks to borrow dollars and lend them locally. Collateral, such as government bonds and property, are usually used as assets with little risk to underpin market activity. However, this perception of safety can lead to risk emerging as lenders become more comfortable extending a credit against these assets. Sometimes, the assets themselves are safe, but the lending and use of the money are not. During the 2007-2009 global financial crisis, collateralized lending soared due to the belief in the American mortgage market stability. The collapse did not require mortgage-backed securities defaults. The mere change in default probability increased the value of credit default swaps and the liabilities of firms that sold them, sinking institutions that sold massive amounts of the products. Crisis exposed collateral misjudgments. Their innovations changed collateral. The Fed's daily swap lines were introduced during the financial crisis and reopened during COVID-19. The Fed's Bank Term Funding Program, introduced after the collapse of SVB, is the first innovation in collateral policy during the present financial wobble. The program's generosity is both new and shocking. A 30-year Treasury bond issued in 2016 is worth around a quarter less than its face value in the market today, but is valued at face value by the Fed if an institution pledges it as collateral. In the program's first week, banks borrowed nearly $12 billion, as well as a record $153 billion from the central bank's ordinary discount window, at which banks can now borrow without the usual haircut on their collateral. The program could change the understanding of collateral that has built up over the past 150 years. If investors expect the facility to become a part of the regular panic-fighting toolkit, as swap lines have, then long maturity bonds would enjoy a new and very valuable backstop. In conclusion, this would mean that financial institutions benefit when interest rates fall and their bonds rise in value. And when rates rise and the bonds slump in value, the Fed comes to the rescue. In an attempt to remove the risk of sudden collapse and make the financial system safer, policymakers may in the long run have done just the opposite.